Hello and welcome to True Options Masters monthly market outlook for June 2022. Guys, if you like this video, please like, comment, and subscribe. It helps us grow our channel and get True Options Masters out to more and more people on the internet. So before we get started with our monthly market outlook today, Mike, I want to talk to you about the greed gauge. Mike Carr just dropped a brand new sentiment indicator that is arguably the number one sentiment indicator available anywhere on the marketplace. So Mike, we just went live with the greed gauge last night. We finally revealed it to the public. Tell us a little bit about the greed gauge. You've been working on this for really the past year, so I'd love to hear from you about it.
So most analysts focus on fear for some reason, and that reason obviously being the VIX. The VIX was calculated to find the value of premium in options. And the premium will rise when markets are falling. So fear is really easy to measure. It's the easy way to do it. Figuring out when greed is at play, that's a lot harder. So I've been spending some time looking at when we can find when investors turned greedy. And Chris, it's a coincidence because we work on these videos, we get everything ready, and we were ready. The greed gauge has just turned bullish on a number of stocks and indexes right now. And, we couldn't have asked for that to happen, but it is telling us this is a great time to look at this indicator. You may find it's the most powerful indicator out there.
Yeah, it really seems perfectly suited to right now. It's the greed gauge. It measures greed, it measures sentiment, and sentiment is arguably the number one driving force in the market right now. We are seeing extreme levels of fear, and that pivots to extreme panic buying. And the greed gauge is even more sensitive during these periods. So you brought up the VIX, Mike. So the VIX is casually referred to as the fear gauge. And you've said that your greed gauge improves on the VIX in a number of ways. It actually fixes three problems in the VIX. So the VIX is a 30-year-old indicator. So it seems like it's about time for something new and improved to come out. So can you tell us what it is about the VIX that has issues and how the greed gauge fixes it?
Well, the VIX itself isn't really a timing tool. It just is high or low. We don't know anything more than that. And I think what's interesting now, you mentioned sentiment is bearish, and all of the surveys are off the charts bearish. But that's what people say. So the greed gauge measures what people do, not what they say. And a lot of times in polls, we know from political polls, people lie. They don't really mean to lie. They just say things that they think the pollster wants to hear. And I think we see that to some extent in the sentiment surveys. So right now, the greed gauge is saying buy, while the surveys are saying most people are extremely bearish. In addition to offering us a timing signal, the greed gauge applies to any stock, whereas the VIX technically applies only to the S&P 500 futures. And very few of our viewers are even trading that market, yet they're watching the VIX trying to get some ideas from it. True, there's a high correlation between the S&P futures and SPY, but it's still not the way I would try to trade. If I'm using the VIX, I'm trading the S&P futures. So that's what we have here, is just an indicator designed for the right market, the right time, with a timing signal.
Okay, understood. That sounds like a number of advantages. It can apply to individual stocks, which can make more money in individual stocks than the market as a whole. It's got the timing component, and it measures the sentiment that actually leads people to buy, which is greed instead of fear. And as mentioned, the fear is kind of backward looking. It tells you what's already happened, whereas the greed gauge, I've seen it. It has this timing component that actually kind of lets you see when sentiment is beginning to turn. And that generally correlates with big moves in stock prices. So it is June 1st. Mike's team just recommended a brand new set of trades using the greed gauge. If you want, you can head over to www.greedgauge.com to learn all about this new indicator. Again, that's www.greedgauge.com to learn all about it. So Chad, on that note, I want to talk to you a little bit, because in your recent editorial, you've not minced words. You have said unequivocally, we are in a bear market. Chad, can you touch on that for a couple minutes?
Yeah, sure. Thanks, Chris. And, that's awesome to hear, Mike. I think that, speaking of being in a bear market, just when you look back at any bear market that we've been through before, it doesn't mean that things are headed straight down. I mean, that's what things have done for 2 months now, but it doesn't mean that we're going to see that for a year or a year and a half, which is the typical time frame for a bear market to play out. So it means that we're going to see bear market rallies, and those are some of the most violent, volatile rallies that you experience. Nothing like you see in a bull market where it's just kind of a steady climb higher. In bear markets, they are some sharp rallies that you don't want to miss. And it sounds like Mike's timing tool over there could really help you kind of jump in and not have to hesitate on, whether or not we're in a bear market rally right now, or whether it's kind of a head fake and about to head lower. Because when I look back, I like to compare this scenario that we're in right now. I think it's very similar to the dot-com bubble. I'm not saying it's identical and it's going to play out the exact same, but I do believe that it's very similar because we had these high-flying growth companies that just, exponential growth, going to continue to climb forever, that they soared after the pandemic. And then those are the stocks that have crashed back to now most of them are below their pandemic lows. So we had that sharp crash back in 2020 on the pandemic. These stocks went ripping higher since then, and now I've crashed 70 to 80% to hit new lows on those charts. So, and this is a big group of stocks. So we're not talking about 5 or 10 or just a dozen. We're talking about several dozen companies here that have just been crushed in the market. And I think that's reminiscent of what happened in the dot-com bubble, at least in the first phase of that bear market. And this is what we talked about some last month, is that what happens next typically is that the weakness kind of rolls over into some more of the safe plays, because we're in a weak market environment. And while it's been focused on one section, those high growth companies for the most part so far, what we saw here kind of over the last month is that it kind of rolled over into these more stable, safe plays. I remember the big, the chain stores like Walmart, Target, they were getting hammered. Other safe haven stocks, because last month, part of our sector analysis told us to be bearish on consumer staples. So those were the safe haven companies that were held up nicely during the initial sell-off, and then those started to roll over a bit last month.
Chad, I was talking to you about this, and I was thinking there must have been some sort of correlation between right now and the year 2000. They say history doesn't repeat, but it does rhyme. Because in 2000, we know that there were a lot of these high-flying tech stocks that didn't really have real, businesses, real earnings, and they crashed 70, 80% within the first few months of the bear market. Of course, the bear market continued for another 2 years. And it does seem like we're seeing that right now. We've got Robinhood, Roblox, Square, Facebook, Netflix, even some of the, we're talking not just some of the most speculative companies, but, some of the FANG stocks, Teladoc Health, Zoom, of course, all the ARC innovation stocks that Kathy Wood owns. So it does seem like there's a similarity, and it did make me wonder if we're going to see the selling sort of roll over. And so after you told me that, Chad, I do want to say this. I started looking at some of the safest companies, like stocks that actually went up in April. Kellogg's is one of them, and I bought a put option dated all the way out to like August or September. Within a few days, I made 83% on that trade. So thanks for that, buddy. Nice. Once you told me that, I started looking for some of the stocks that were still very high up, and it looked like the momentum was beginning to turn. So I was actually able to use that to collect a nice profit. So thank you for that. Mike, let me ask you. So the objection I hear to, it's not the same as 2000. It was just companies adding .com to their name, and high flying, nothing companies that just added a website and soared 1,000%. So one of the objections I see right now is that it's not the same. We have real innovators, real businesses doing incredible, revolutionary things. What do you say in response to that?
It's absolutely not the same. And the bulls are saying it's a disruptive economy. So we need to look for the stocks that are disruptors. And that's a big ARC theme too, as we look for the company that's going to disrupt the industry. Well, the economy is in a state of disruption right now. In 2000, we were moving towards globalization. We were bringing China into the global economy, and we were setting up a period of low inflation. Today, we're deglobalizing. We're pushing China out of the global economy in many ways. We're pushing Russia out of the global economy. We are setting up a period of higher than 2% inflation. And I think even Jerome Powell would agree with me on that, we are in a period of higher prices. So it is much different. And when you have higher prices, you have higher inflation, you have higher interest rates, you have lower PE ratios. That's just discounted cash flow analysis that every Wall Street analyst uses. So we are in for most likely a grinding bear market, just because you're right, it's not 2000. It's an equally disruptive time, but it's a negative disruption.
Gotcha. But that doesn't mean that those stocks can't head lower. And I think that's the objection they have, is like, oh, these are disruptive companies and the market likes to invest in the disruptors. But what do you think?
They're the wrong disruption. So what we need to look for is not a company like Peloton, which is going to disrupt the gym business.
Right.
That's trivial right now. The global supply chain is being disruptive. We need to find the companies that are going to be the centerpiece there. And in today's Wall Street Journal, President Biden says he's going to focus on lowering costs, lowering inflation by trying to target the profits of foreign shipping companies. So right there, that tells us shipping sector is somewhere to look, because regulation is coming. Who knows? Maybe Biden will do away with the Jones Act, create more competition, and lower the prices. I doubt it, but it's possible. So bigger picture themes. It's not enough to just say, this is a company that's using technology in a new and unique way. What's important is to understand how that's going to fit in with a global economy that is much different than anything we knew about for the last lifetime.
On the note of, deglobalization, and obviously we're seeing, the United States sort of like pushing Russia to the side and all that stuff. I will say this: I saw the new Top Gun Maverick movie this weekend. It did $280 million globally, and it's not airing in Russia or China. So that to me says a whole lot about what you're saying about deglobalization, but also the fact that there's light at the end of the tunnel. $280 million globally without those two big players. I think it's very interesting. Seriously, though, if you haven't seen Top Gun Maverick, it's fantastic. Go watch it. All right, Mike, let's go ahead and look at your charts for today.
Okay, Chris, I am going to focus on just one chart. So I added a lot of stuff to it, and let me walk through it. This is a chart of SPY, greed gauge here at the bottom, close to the bottom. And as you see, very clear buy signal. Below that is VIX, just to show the comparison. And there really is no comparison. VIX is headed down. It's at maybe the same level it was at earlier this month. I don't have any information from that. I don't know whether that's a buy or a sell, because it was a lot lower in April. It was higher in March. There's just nothing there to tell me what to do. So the greed gauge, I believe, a definite improvement there. It's showing investors turned a little bit greedy here after we got this big down day. Now, going back up to the top here, this indicator, this is the percentage of trading activity that was to the upside. And this has been a volatile market. Excuse me. The gray line here, it's 70%. And what we see is some days during that decline, buyers got extremely optimistic and they were mostly on the buy side. Well, last week we got 3 days in a row where buyers pushed the up-down volume ratio to 70% or more. That means at least 70% of the volume was on stocks that moved up that day. That's significant, but low price stocks can influence that. So the next line here, this is the advanced decline line. This is basically what is the percentage of individual stocks that closed higher that day. And it was also above 70%. We also see as stocks were bottoming, the advanced decline ratio, this is a breadth indicator, was diverging. This is a bullish divergence with a low down here. As prices were falling, we were getting an up move in that indicator. We saw the same thing in the percentage of volume activity. Breadth is bullish. This type of pattern, 3 straight days where the up-down ratios are above 70%, indicates we are more than likely to see at least a short-term up move. And when I say a short-term up move, there's about an 80% probability we move at least 10% off the low. That's about 4% from where we are now, but that's going to come into play right at that 50-day moving average. That's going to generate some excitement. We're going to overshoot. This is our first bear market rally. It's likely to take us 12 to 15% off that bottom. So we have a target above 430, and then the next down leg starts. But we have a lot of reason to expect the greed gauge and market breadth telling us look for a push to the 50-day moving average. So one chart, but I think quite a bit on it.
Yeah, quite a bit indeed. So we did see a rally in the 2 weeks, I think March 15th to March 14th to March 29th or so. S&P 500 went up about 11%. So you think this move is actually going to be bigger than that?
Yeah, I do. The AAII survey showing that the number of bulls is extremely low. So we're at about 20% bulls. About 80% of individual investors are neutral to bearish. The neutral camp is looking for a reason to buy. The bearish camp is looking for a reason to say, okay, that was enough. And I think we almost had enough. If we look from high to low, SPY came down about 18% almost. A lot of people are going to say 18 is close to 20. That's a bear market. This rally is real. I'm buying. This is largely a sucker's rally in plain English. It's designed to suck in individuals who aren't ready to accept that it's a bear market. And it should go much further than anyone expects before the bottom drops out again.
Well, I got to say, with something like the greed gauge, it kind of helps you make money without being a sucker, because it looks like in mid-March, it got you in shortly after the bottom, and it got you out in early April before the bottom fell out. It looks like, in fact, before it even dipped below that moving average you see at the top there. So this thing seems to be working, Mike. So I'm going to be listening to you very carefully for the next coming weeks. That's good to hear that it seems like this rally has more legs, because S&P did rally a lot late last week. We got some good inflation news on Friday with personal expenditures. Month over month, it dropped from 5.2% to 4.9%. Of course, a little bit later this month, but in June, I should say, we're getting new PCI data. So do you think that market's going to be watching that very closely? Do you think it's probably pretty likely if we saw personal expenditures drop a little bit month over month, we'll probably see the other inflation data do the same?
Yeah, I think so, largely just because of the way the CPI is calculated. We're probably going to see lower numbers coming in. Now, prices are still going up, and they're going up a lot. We probably have a year until the impact of the housing market is fully factored in, because CPI goes up just a little bit every month as housing prices skyrocket. So we have a lot of catch up to do there. We're probably going to come down steady state into that 4 to 5% range by the end of the year. And we're going to hold there for some time. I think the Fed is going to push short-term interest rates a little bit above 4 just to show that they're serious. They have to get above the CPI. Otherwise, the market's going to say the Fed's not really serious. So this tightening cycle will end with the Fed funds rate above the CPI rate, and it's a lot of pain ahead of us.
Gotcha. All right. Well, this looks great, Mike. Definitely feeling good about June. So Chad, we'll go ahead and turn it over to you. Now, Chad, last month you were bullish on one set of consumer stocks and bearish on another set. I know today you're going to be looking at a new sector that I assume is going to be bullish for this month. So why don't you go ahead and show us what you see?
Yeah, you're right on, Chris. I am bullish for this month. I'm looking for this rally to at least stretch for a couple more weeks. I do believe that it's a sucker's rally, like Mike mentioned. So I'm not trying to ride this thing from calling this like an ultimate bottom and looking for stocks just to continuously shoot higher from here. But I am looking for a nice little bounce, like he's talking about. It should overshoot that moving average. So a nice little pop for the S&P 500 to move higher, and that's going to carry a lot of stocks in sectors within it. And our sector that we're looking at to move the most here on this rally is now the consumer discretionary stocks. So these are the ones driven by the consumers. So as this rally starts to take off, those stocks have been kind of beaten down pretty hard. I'm looking for those to have a nice bounce out of this. And this is my profit radar that we're looking at here. So just a quick recap on what we try to spot. The center of this thing is the S&P 500. So we're looking at how all the sectors that make up the S&P 500, these are the core sectors, are rotating around it in their performance. So the top right quadrant here is the leading quadrant. Then we have the weakening quadrant before they rotate into the lagging, and then they come back to improving and then leading again. And they just kind of continuously make this rotation through the market for the most part. So the trick is to catch stocks that are coming out of this lagging quadrant and looking for them to go through improving and then leading to get the biggest returns over the next couple of weeks, because this is a daily chart here that we're looking at. So we're only looking for these moves to last just a couple of weeks. So this is kind of lining up perfect with the big swing that we're expecting here in the stock market. So in the consumer discretionary sector, we always like to break it out and take a look at some of the stocks inside of it, so that way we can have a few stocks to really keep an eye on to focus for the biggest moves in the market. Now, the two that I really like are going to be Tesla, and you can see that it's the blue line through here that's starting to make this turn higher, and it's heading right into the improving quadrant up here, and then Carnival, because it's kind of doing the same thing. And we see multiple cruise line stocks here. We have Norwegian Cruise Lines, Royal Caribbean, but Carnival, they're a little further to the left, which signals that you're going to see the biggest moves the further they are to the left, because that's the volatility basically for the stocks, the further they are away from the center. And then it's already heading in that nice direction into the improving quadrant. So we're going to ride a Carnival in Tesla this month, and then kind of take a flyer down here on Target, because it hasn't made the turn higher yet. It got crushed on earnings the other week. So you can see that big drop out of this price channel. Now we're just looking for a bounce. I'm not saying that Target's ultimately bottoming here or anything else, but you see it's already moving higher. We're just looking for this bounce to carry through over the next couple of weeks. And since it is a volatile stock now, you can see a pretty strong rally out of that, and it would still be a beaten down stock, even if the shares pop 10% from here. So those are the three that I really wanted to focus on this month, because we're looking for that rally to last over the next couple of weeks.
Well, if you look at UA and UAA, United Airlines, and I'm not sure what that other one is.
They're both Under Armour.
Oh, Under Armour, and they're both Under Armour. Okay.
Yeah, they just have a different share.
Gotcha. Well, I mean, if you look at the way that turned, clearly the same thing could happen with Target here. But it does look like the safer bets are Tesla and some of the cruise liners. So Tesla's an interesting stock, because for the longest time it was an impossible stock to short, but it fell a lot in the last month. Finally, we're seeing the selling start to turn over to those quote unquote safer, relatively speaking, tech names. But it's a very desirable stock, so we can definitely see that one rally pretty hard here. I got to say, Chad, I'm hearing from just a lot of friends, personal anecdote, people buying tickets for cruise liners. They've been in a downtrend. I mean, really ever since the pandemic, but even over the last several months, they've been turning lower. It looks like, here we go. Exactly. It's been in this channel,
and they never,
and it's bouncing off the bottom of its channel. So
yeah, this is from the pandemic. So they never recovered. Most of the market really recovered from that and then had a sell off. They never were able to recover because they were literally shut down. And then as they opened up, the market just kind of rolled over again. But people are taking cruises. There's a lot of people that love cruises. And, now that the virus gets kind of put behind us, even more so now, people are just looking to get out, take a vacation. and they're going to definitely hit back up on the cruise lines. Just a matter of these things. They're struggling because of all the downtime, but the stocks are showing it. The stocks are showing that they're struggling. So again, with the play today, though, we're just looking for this short-term bounce. Could run back up in this channel since it is holding this. So it didn't, even with the sell-off, it's not breaking down out of any, key levels on their price chart.
I see stuff like that, and it makes me laugh when people say that technical analysis doesn't matter. It's clearly responding to these moves within its price channel. So,
but yeah, that's all I have for this month to keep an eye on.
Okay. Okay, thanks to our viewers for tuning in to our monthly market outlook. Again, if you like this video, please like, comment, and subscribe. It helps us grow our channel and get True Options Masters out to more and more people. Again, very busy month. We just launched our newest indicator, the Greed Gauge, courtesy of Mike Carr. If you want to check it out, go to www.greedgauge.com to see what it's all about. And we feel very good about June. June should be, yes, they describe it as a sucker's rally. And it will be a sucker's rally for people who want to buy and hold stocks at this point. Now is not the time to buy and hold. Now is the time to trade. And the great thing about being a True Options Master is you can lean into these sorts of rallies when they're happening and get out before the momentum shifts back to the downside. Bear market rallies are some of the best money-making opportunities out there. You can make so much more money much faster in a bear market rally than you can in a bull market rally, because you see sentiment driving these extreme levels of fear, and it creates oversold conditions, which can switch on a dime like we've seen a couple of times this year already. So whether you're using an indicator like the Greed Gauge to help you identify these oversold moments, or whether you're just using that information, the fact that we're in a bear market and that these bear market rallies can occur within the larger downturn in the market, you can have a major ace up your sleeve that the vast majority of investors simply will not have. So with that said, thank you guys for joining us. We'll be back with more videos later in the month, and make sure you tune in next month for our next outlook for July. With that said, stay safe out there, and thanks so much.